Hello, my name is Ennis. I am a current Wharton senior, and I'm here to present my thesis, which is titled Lever Up and Drill, the statistical analysis of practical financial decisions made by oil and gas firm executives. My faculty advisor for this research project, Professor Eric Gilliam. So to start, the oil and gas industry went through a very significant shakeup in 2014-2015. In November of 2014, the oil producing exporting countries of the world met and determined they were not going to cut production quotas. This caused a free fall in prices related to oversupply of oil. The equity and production equity prices moved in lockstep with this, and by mid-2015, big name firms like Samson Resources and Speed Oil and Gas were filing for bankruptcy. By February of 2016, average firm values had fallen about 60%. Chesapeake Energy, one of the largest natural gas producers in the world, had share price fall from $30 to $2 over the time period. In fall of 2016, we've seen a little bit more stability in prices, and resulted in a lot of M&A activity. And it's interesting to think about what firm executives will decide going forward in light of this recent collapse. As I mentioned earlier, starting in April, May of 2015, we see a string of bankruptcies throughout the North American exploration production space. So you can tell that the way that firms think about these different financing decisions is really important. It definitely has a lot of significance right now. And one of the kind of critical things to think about as we went through this process was the heterogeneity in capital structure of oil and gas firms. Some firms, as you see here, are spending over 45% of their revenue on interest expense. So the debt-to-equity ratios vary tremendously across the space, especially prior to the collapse. So high-leverage firms pushed into bankruptcy, and low-leverage firms were able to weather the storm and were presented with a lot of valuable M&A or A&D opportunities over the course of 2016. So our goal in this research project is to understand how commodity prices factor in to the capital structure valuation methodology decisions made by oil and gas firm executives. So to do this, we surveyed a subset of the North American E&P companies, and the survey was based off of the 1999 survey conducted by John Graham, Duke University, and Campbell Harvey of Cambridge, titled The Theory and Practice of Corporate Finance, which surveyed just under 400 firms across all industries about various financial decisions and capital structure and cost of capital. So to dive in a little bit more about what our survey studied, we did about a 10-minute survey, 4 parts that we sent to 394 oil and gas executives. They were asked to assign probabilities to different price buckets for 2018, so what they thought the price outlook distribution was going to look like. We asked them to rate different price estimation methodologies. That's use of analyst reports, the futures curve, a good estimate, price is too volatile to estimate going forward. We also asked them about different project valuation methodologies, classic kind of NPV, IRR, payback period. We also added the hurdle rate, because I think this is a big thing with a lot of private equity-backed E&Ps. It's an important metric that they use. And then lastly, we ranked capital structure. We asked them to rank capital structure decision factors, such as interest expense deduction, credit rating, commodity prices, factor into those, and then lastly, the cost of bankruptcy or financial distress as that plan. So we had 35 different oil and gas executives respond to our survey, about a little under 9% yield, which is close to the slightly over 9% yield that Graham and Harvey had on their study in 1999. So to start, look at the price outlook in aggregate of these different executives. The prices are slanted somewhat higher than the $54 contract price. At the time of the survey, which was late February 2017, you can see a kind of sizable amount thinking that it's going to be in the $55 to $60 range. And the average bucket density ranged from about 8.3% to 50%. So firm had a 50% density. That meant that they ascribed all of the probability in their distribution to two different buckets. So they thought, oh, their universe is going to exist between $45 and $55 per. Unfortunately, Qualtrics, the survey software that we use, does not time individual questions, so it's difficult to tell if a respondent's spread was correlated with the time it took to complete the survey. As someone that sees a wide range of volatility, actually just someone who's taking a little bit more time to be meticulous about the probabilities in these different spaces. So the next thing that we surveyed these firms on was price estimation methodology. Firms stated to us that the least viable price estimation tool that they found was commodity price futures curve, which is really interesting because the commodity price outlook, as you saw, was very significantly bunched around what that future curve is saying. And perhaps this is because firms are able to lock in prices via hedging the futures curve. They don't think the future curve is a good estimate of prices are actually going to be, but they can use the futures curve to obtain hedging and kind of lock in those prices ahead of time, so they don't need to bet, so to speak. And then lastly, when we ran a regression, we found that these price estimation methodologies, the ratings are not at all correlated with the average price, nor with the density in the different buckets. Next, we looked at valuation methodologies for individual projects. These rankings were very similar to the Graham and Harvey study, and BVNR being very popular, and then more complex methodologies being less often in usage. Much like the Graham and Harvey study, we also found that payback period was the third most popular technique, which is interesting because most finance textbooks will state the obsolescence of this method because it disregards the time value of money, cash flows that happen after the payback time period. But we think, for cash-strapped oil and gas companies, something like payback period, there's a project's going to be able to pay you back before you potentially face the bankruptcy, is actually a very important method. Then lastly, we found that hurdle rate firms, or firms that use hurdle rate more often than not, are significantly more likely to set a target capital structure. So it kind of fits the private equity mold of trying to hit a certain IRR and coming up with a appropriate debt covenant for a portfolio company that kind of fits those needs. The last thing that we studied was the capital structuring decisions of these firms, specifically the importance of certain factors when determining the appropriate debt level. One of the things that we found interesting was that despite flexibility, financial flexibility being the most important factor, bankruptcy cost, which is kind of the end-all cost of not being flexible, was the 8th highest ranked. So some discontinuity there. We also saw that despite the futures curve being the least viable price estimated methodology, it is ranked 3rd here as the most important when determining debt levels. I think that goes to show that because firms are able to lock in hedge prices at that futures curve, they can build a capital structure around that and come up with an appropriate amount of risk. And lastly, we found that the comparable competitor debt levels were the least important factor when determining a firm's capital structure, and this shows some support for the heterogeneity in the industry because firms are much more interested in their flexibility, in their kind of personalized capital ratio, and their ability to lock in prices via hedges going forward. We also took a look at the statistical relationships across categories, and one that we really wanted to focus on was whether commodity prices were able to predict the importance of bankruptcy in terms of determining capital structure. And we found that firms with a higher commodity price outlook, and we're surprised by this, more likely to rank bankruptcy costs as a priority. We think that maybe this is because these firms see a higher price outlook, are less conservative with their pricing, but will recognize that risk through pricing in some sort of bankruptcy costs. More in contrast here, but in line with what we hypothesized, that firms that stated a higher probability of prices being above $60 were less likely to rank bankruptcy as a priority. And that makes sense that these firms that truly believe that there's a strong upside potential aren't going to think so much about bankruptcy. So in conclusion, price outlook was slightly higher than the futures curve. Estimation methodology had very little impact on what the price outlooks for these firms looked like. Popularity of different valuation methodologies was very similar to the industry agnostic Graham and Harvey study. Firms that use the hurdle rate methodology were much more likely to set a target capital structure in line with that private equity sort of model. The debt level of competitors was the least important factor in determining optimal capital structure, explaining the heterogeneity in the industry. And lastly, the importance of bankruptcy costs rose with the firm's price outlook until the firm had a significantly strong belief the prices would be above $60. Thank you for taking the time to listen to this presentation.